for audit and in-day series, which we have planned every Tuesday at a WIRC 5 to 7. So we have already completed 5 to 7 series till now on a lot of index related topics or audit related topics. Today we have CA Vaibhav Gupta and CA Suvir Khanna with us as a faculty. Uh, I would request WRC to first do a motto song, and then we'll take up the next steps.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Thank you. So overall, our intention was through a virtual series. We reached to maximum participants to give a lot of perspective on a lot of index items and an audit of typical areas. So hence we started this series on every Tuesday. Uh, we are lucky enough to have two eminent speaker who are part of auditing a lot of automotive clients industries. I can put before giving a brief about them, I can say one thing because knowing them professionally, uh, one would assume that whenever we go in, for an audit of an automotive client, okay, we audit, we be an OEM or an OEM supplier. I can tell that both of them have collectively or individually audited even uh, suppliers to an OEM and even OEM. So one can say if they need to audit a car, they have audited all the suppliers, so they can just make an assembly of an audit and present us. That vast experience both of them carry in this particular field. With regard to Vaibhav Gupta, who is partner with SRBC and Co LLP, Vaibhav has around 24 years of experience in audit of financial statement under Ind AS IGAP for a lot of multinational companies, Indian promoter group companies. He has extensive experience in statutory audit, group audits, limited review, etc. of large private limited companies. His sector experience is automotive, engineering, technology, and diversified industrial products. Vaibhav Gupta is a chartered accountant and also bachelor degree in commerce. We have today, one more speaker, Suvir Khanna, who is a director with SRBC and Co LLP. Suvir has around 14 years of experience providing assurance services for the listed companies and large public limited companies. He also has an experience in statutory audit, group audit for large multinational companies. His experience is with regard to service organization, having cost plus entities, technology companies, automotive, and Suvir is also by academic chartered accountant. Today, I think so, over and above discussing on how to audit a lot of areas, the more focus would be the typical issues which are required to keep in mind when auditing an automotive industry. Those are the things which we are factoring today, and hope Let's keep this as much as interactive. You can put your questions in a Q&A box, and throughout the session, at the end, they would cover up all the questions. Over to you, Vaibhav and Suvir.
Thank you, Chandan, for the kind introduction to both of us, some kind words.
Voice.
Thank you for this
Vaibhav,
opportunity.
Vaibhav, your voice is low.
Is it better now?
Yeah, yeah.
Okay. Thank you, Chandan, for the kind words. We'll probably directly jump to the session and present our slides. Let me know once you can see the slides. And then I guess, yeah. So I think automotive sector per se, I think is a very broad sector. Okay, so before we dive in there, I think just probably setting some expectations for today. We come to the next slide. We probably just showing you how we will present, how we will flow, what will be the flow for today's session. We will generally cover what is of automobile industry. What do we mean by that? The term is very vast, covers a lot of things. We give you a very quick insight into the global sector and how the Indian market looks against the global sector. What are the key challenges which are faced by companies in this sector, whether it is an OEM or a OEM supplier? Okay, I think each one of them have their challenges. There's a lot of interplay amongst them. Okay, so we look at that, and then we picked up certain sections, accounting captions, and we probably dive into them a little more in detail. We will, though it says Q&A towards the end, my request will be you can keep posting your questions in the chat box. As much as possible, we'll try and answer them immediately. Else, we'll probably come back to it towards the end of the session. Okay, I think that will be the flow of the session. Very quickly, I think when we say voice is still low. Give me a minute, I'll see if I can adjust the speakers, the sound.
सर आपका माइक थोड़ा सा नजदीक कर लीजिए सर.
Okay. Just checking if my voice is better now.
Yes sir.
Okay, thank you. Sorry for the inconvenience. So I was referring to the fact that automobile sector is a very vast sector. Okay, I think what we mean by automobile sector is something what we've tried to depict on this slide. It includes two-wheelers, three-wheelers, passenger cars, and commercial vehicles. I think this spectrum includes the foray of vehicles which are there on the road. Whatever you see is included in the automotive sector. Starting with two-wheeler, I think right from a 50-60 cc moped, we see the most biggest the super bikes on road these days. Post-COVID, we have seen the people, the urge for people to really have super bikes and enjoy that. I think that is increasing post-COVID, which because of which we see a lot of Ducatis, Harleys, and all these super bikes on the road, Kawasaki's to name a few. Similarly, we have passenger vehicles. I think India is a vast market. I think we're the most populous country, and hence, and of late, India has had a good affordability in terms of the middle class sector segment is rising. Okay, it is expanding, which gives a lot of access to some of these utilities, and hence the desire to own a car is a very natural desire for a middle class person, and that is what makes India important. While world is growing at a particular phase in the automotive sector, India is growing much faster than that, and hence we see companies like Maruti, which are doing so well for so many years. It captures more than 50% of the market share for a reason. And that's probably, as Indians, we are known to attracting value for money as a concept. Okay, most of us still look for, there are some ads, right? Kitna deti hai, mileage and all that, I think, right? That's how we still look at cars. And equally, there is a segment of people where they look at luxury over and above price. They're ready to pay a few lakhs extra for certain luxury features and certain comforts in the car. And hence, I think that opens up the Indian market from a four-wheeler perspective, passenger vehicle perspective, where you have every type of player available in India and global companies eager to come in. And people who've been in India, I'm sure you must have heard of names who are trying to go for an IPO and things like that. Uh, I think commercial vehicles, not too much has changed here over the years. We have seen buses becoming going the green way. Trucks haven't yet. I think the infrastructure probably is a big roadblock there right now. The day we have good roads and good infrastructure, I'm sure we'll have those super trucks which we normally see in films or movies, or English movies. We probably will be seeing them on roads as well. But I guess in my personal view, that's a little far away. Largely, that's what is automotive sector. You want to add something?
Yeah. I think in addition to what Vaibhav mentioned, when it comes to the automotive sector, in addition to the OEMs and the component suppliers, you also have some more aspects which get covered under this sector. First and foremost is something with respect to research and development. We have seen that because of the talent pool that we have in our country, a lot of automotive companies have opened up their R&D centers here. You have global players that have opened up R&D centers in India, as well as local companies which have their own in-house R&D centers in India. In addition to that, you would also see that there is a need for all automotive companies to ensure that whichever vehicles are launched within the country, they have due testing that has been performed by an external agency.
Suvir,
Yes.
I think so. I got a call from few members who have joined. They are facing issue with audio.
Okay.
What can we do?
Yes, give us a minute, Chandan.
Yeah, is it better now?
No way.
No?
Better.
Better?
Now?
Suvir, you
Okay.
can come
Yeah.
nearer.
Yeah. Should be better now?
Yeah.
Yeah. Okay.
So participants, let them start. After 1 odd
Yeah.
minute, you can
After a minute
put
or
the,
so, we can probably discuss
yeah.
it.
After a minute, you can put on the chat box if you can't hear.
Yes. So I think coming back to the slides, I think what we were broadly talking about is other aspects that we have which are relevant to the automotive industry. So we were talking about external testing agencies. Like I said, every automotive company in the country needs to ensure that before there are any vehicles that they launch, there is due testing which is performed by an external agency, for example, ARAI. Testing agencies also become a crucial part of the automotive sector within India. Another key aspect that we have is with respect to the dealership network. You would notice that almost all automotive OEMs that we have within the country, they focus largely on the wholesale business. They do not get into retail sale where they sell to individual customers. Rather, they rely on dealership networks where they sell vehicles on a wholesale basis to the dealerships, and the dealerships in turn then go ahead and sell the vehicles to the retail customers. So dealership network also becomes very crucial because this ultimately this ultimately decides how far is the reach of a particular OEM within the country, which geographies can they sort of attract, and what are the cities, the type of cities, whether it is tier 1, tier 2, what are the kind of cities that each OEM would then attract. And the last aspect, which is also crucial in the sector, is with respect to after sales. So while there are a lot of authorized dealerships that the company does have, which get into the after sales and maintenance business, there are also certain non-authorized service centers that we see within the country, and that is primarily because we have such a vast nation. So while they may not be officially authorized as a dealership network of the company, they are still included in the whole automotive sector gambit because they do play an important part in after sales and maintenance, etc.
Yeah. I think as we move on, I think a quick insight into how the global sector looks like. I think on the right-hand side, you will see some big names, okay, which are the global large players. I think Toyota being the biggest, which occupies almost 10% or more than 10% of the market share. VW, Honda follow the suit. Okay. I think this is a sector which, in terms of value, we can say is a $2 trillion economy as of today and is growing at the rate of 2 to 3% every year. Last year, we saw probably COVID impact and significant slowdown. Last year, which is 23-24 from an Indian perspective, was a good turnaround year which saw good growth. And the experts, I think from an Indian perspective, experts believe that the coming year will not be as much. It will probably be a flattish year. Okay. Uh, okay, I'm getting some confirmations that the sound quality is good. Thank you. Hope it continues like this. Um, Specifically talking about the technological changes which are happening in the auto sector, I think this sector is no different than a phone sector where people expect value for money, innovation, okay, the best of the features to be available, but at the same time it needs to be cost efficient. I think which makes it significantly challenging. Okay, the newest features are EVs and hybrid cars. Okay, I think one should understand that some of these new vehicles and the entire setup, it involves significant capex investment. I think normally a product life cycle for a particular model or a model per se ranges from 8 to 10 years in general, which means it takes at least 8 to 10 years, at least, I mean, maybe even multiple times more than that to recoup the initial capital investment if if a model has to really do well. Okay, so I think EVs is the newest baby, and I think hybrid is catching up. What is not hit India, but it is already there in global, is the self-driven cars which Tesla has launched. There are news that this may hit India very soon, but I think it's anybody's guess right now. These are new concepts which are there, which probably will keep the auditors and the finance people busy because all of these have an accounting and the financial impact. Okay. When you talk of EVs, I specifically two things which come to my mind is the battery technology. Okay, how efficient is the battery technology? How soon or how later will I have to replace it? What will be the efficiency of the mileage sort of a thing if you have to really look at it? Okay, and the moment you say charging infrastructure also comes into mind. Will charging stations be available just like we see petrol bunks at every few kilometers in the country? Will you have a similar network of charging stations? I think we are very early in this journey in terms of charging stations, but it is catching up. I think fueled by a lot of support from government who are giving incentives, not only for buying vehicles, but also for setting up charging stations. I think these are avenues which are evolving. And I think from a country perspective, we will be catching up. We will be catching up on this soon. India per se, if you look at it, I think we are the third largest automotive market after US and China. I think we are growing at the rate of 6 to 8%, whereas the global world is growing at 2 to 3%, which makes it a hot market for everybody to be in. And hence you see people coming in here with their brands and they want to be in India. We are most populous, we are growing faster. I think there can't be better reasons to be here than this. The chart on the right hand side shows, I hope it is visible to all. It shows what is tentatively the size of the OEMs. You'll see good 40% occupied by Maruti. It's been like that for quite some time. It was probably bigger and it's been maybe shrinking a bit. Then you have Tatas and Mahindras and Hyundai, I think 14, 10% around that. So these are the 3, 4 players in India who capture good 80% of the market. Okay, and I think the trend today is that most of the global features which are there in the global cars are very soon passed on to the Indian models, and I think that's a challenge as well as concern for the OEMs because it involves, as I said, significant cost. Okay, and at the same time, you will not be able to, or the customer wants the car to be as cheap as possible and having the best features. Okay, so balancing it is a significant challenge for a OEM.
Yes. So I think now, after we've spoken about the overview of the sectors, I think what we want to talk about a bit is on the challenges that we have seen both in the global automotive sector as well as the Indian automotive sector. So we'll spend the next 5-10 minutes talking about some of these key challenges. And please keep in mind that all these challenges also do have a certain accounting implication. So while they do, in theory, appear to impact only the sector or the business as a whole, you will realize that there is a possible accounting implication that arises from each of these problems. The first thing that we want to talk about is, and this is something which has become uh, probably very important over the last couple of years, which is the post-COVID scenario that we've seen. There have been a lot of challenges in terms of supply chain. You would have read about shortages of semiconductors, and that came in largely post-COVID because that's when the demand for vehicles as well as other electronic devices increased significantly. And semiconductors are aspects or other parts that are used in almost any electronic device that you would see. So problems with respect to shortages of certain components, issues, let's say, for example, the Red Sea crisis, which we've seen over the last few months, these have all led to certain supply chain issues, which have had a consequent impact on the production of vehicles and components, both in the OEM sector as well as the automotive component industry participants. The main impact of such supply chain issues is in terms of the manufacturing process. As you are aware, most of the companies work on a just-in-time basis, which means that they need to ensure that they have at least a minimum quantity of all parts at their factory. Else, you could end up with days where there is no production, which would just lead to excessive fixed costs being incurred. So it is important that the supply chain is maintained and there are no stoppages that you would see in terms of components being received.
I think we have seen instances where an OEM has carried significant inventories of a car or unfinished car because they're just waiting for a few components to be fixed. Now imagine, I think a car worth 10 lakhs on an average is just lying there, okay, for waiting for a small component, which could be at time a bulb or could be a chip, okay. And I mean, because without that, you cannot sell that car, okay. And that's the magnitude of how a small semiconductor could impact your turnaround time in terms of sales and all this.
Yes. And I think shortages that like these also lead to inventory pile-up issues, wherein you then need to keep, keep at the back of your mind at least the aspect with respect to aging of inventory and whether or not there is need for any slow-moving or obsolete inventory provisioning that could creep in. Only because you have, let's say, a finished product which you are unable to sell because of shortage of a particular component.
I think storage of these unfinished inventory is also a big concern. Where will you store so many cars or two-wheelers which are manufactured? It just cannot lie there. And these are not packed in boxes like any other product. And hence, I think those are the additional challenges which probably, because otherwise one can see that a car will ultimately get sold in a matter of time, 2 months, 6 months. But the damage which happens when the car is just standing in the yard for 6 months, I think that is also something which has to be kept in mind. Then I think the next aspect is dependency on key suppliers. I think here again, if you look at it, OEMs have a choice. OEMs don't manufacture everything. They have back-to-back arrangement with several suppliers. Here the choice is, do you want to have sole suppliers or do you want to depend on more than one person? Both have their pros and cons from an OEM perspective. When you have a single vendor, I think you can ensure quality, just-in-time deliveries, etc. But I think the challenges of having a single supplier is the fact that if there is any concern, we have seen cases in the past where there was a fire incident at the factory or something like that happened, because of which there was an impact on the production. Okay. While insurance may cover the supplier's aspect of the factory's loss, but the impact of this particular component not reaching the OEM just in time and that being the sole supplier creates a big havoc in the OEM's factory because there's a huge pileup of vehicles which makes it unsaleable. Okay. And similarly, I think when you have more than one supplier, just to ensure appropriate quality, both serve appropriate quality, they give you the best pricing, and things like that become a challenge. Okay. I think there is a significant factor of cost as well, because then all your suppliers or both your suppliers, as many suppliers you have, should have consistency in the quality and should be probably giving you similar cost benefit advantage.
The next point that we would like to talk about is with respect to certain emission related regulations. Over the last few years, we have seen there has been a lot of emphasis on reducing the carbon footprint. And the automotive industry is, one of the sectors which is hugely impacted by this because the vehicles that are sold by automotive components have a direct bearing on the sort of emissions that you would see within the environment. There are emission related norms that have come out, which is in terms of the global norms that we have, but we also have the Bharat stage equivalent norms, which have strengthened or become even more strict over the last few years. Um, Getting vehicles to be compliant with the newer norms always requires a significant portion of capital investment, and we have seen that in the industry, both in OEMs as well as component suppliers. More so, component suppliers that are involved in the exhaust manufacturing business, because that is one of the critical components that lead to emissions. We have also seen the CAFE norms, which is the corporate average fuel economy norms, kick in sometime towards the end of 2022. And that requires OEMs to make sure that the vehicles that they are manufacturing have a good average fuel economy, because that in turn would mean that the emissions that the car leaves are lesser than what a non-fuel economic vehicle would do. I think what this requires is first, obviously, to check to see the extent of capital investment and whether or not that cost will be recoverable eventually. And it would also be important for OEMs to ensure that they have developed the right set of vendors who can then supply the required components in a timely manner.
I think safety standards, I think, is also a significant thing, because I think this is where I think as a regulator they pitch in, because they ensure that every car should have a minimum safety requirements included in the car. Okay, now whether it is in terms of airbags or etc. Okay, the global standards are a little different. Indian standards are still a little lenient. I guess we are getting there. Indian authorities are becoming stricter on this aspect. And we are catching up. I think Indian cars will at some point become equally safe as certain other global brands and cars sold elsewhere in the world. Okay, but I think it's always a play of cost and affordability. In India, I think it also has to see. I mean, whether you really travel in that at that speed where you really need that much of safety. But yes, as the roads get better, I think we need to have safety aspects in our car also inbuilt. It has to fall in line. It will in due course. Moving to the last aspect on the slide, which is on the cyber attacks, and I mean, the more you use chips, the more you make it automated. That is, with that benefit comes the risk of being hacked or being controlled by somebody else. We haven't seen too many cases in India here, but probably globally, this is one of the risks which comes along with an automated car, which has more chips and everything else, which is controlled electronically.
Coming to the Indian environment, and we'll talk about some challenges which are specific to the Indian environment now. I think the first is with respect to regulatory aspects. In addition to only the emission-related changes, we have seen, a number of regulatory changes that have come in which impact the sector as a whole. I think what this really means is that we as auditors need to place a little more emphasis on staying updated with what are those regulatory changes, how they impact the balance sheet or the P&L of a company, and ensuring that there is due disclosure, accounting, presentation and disclosure requirements, etc. All those are met in the financial statements of the company. The next aspect, I think, to touch upon is with respect to infrastructure. I think this is something which is very relevant considering the shift that we are seeing from internal combustion engines to electric vehicles right now. You would have seen that the share of electric vehicles in India is on the upside. It is growing currently, and that is fueled more by more players entering the market right now, as well as certain benefits that the government has given. So there are some subsidies that individual buyers are eligible for. There are subsidies that are coming out from the central government as well as respective state governments in terms of registration or RTO related charges being at a discounted rate for electric vehicles. The central government has certain lesser GST rates for EVs, and that leads to a lesser cost to individuals. But at the same time, I think companies also need to make sure that there is adequate charging infrastructure. A lot of OEMs themselves are getting into agreements with EV power companies, etc., to make sure that there is adequate infrastructure for electric vehicle charging. And the government is also supporting this by giving certain discounts, etc., to EV players to make sure that the infrastructure setting up process at least is speeded up to a certain extent.
And I think we will eventually see here in some time that probably you will see a couple of OEMs come together and partner to create an infrastructure, because individually, I think nobody will be able to create an end-to-end infrastructure. you don't need to really. I mean, that's not the way you need. For example, you don't want to have a Maruti charging point every few kilometers, and you also have, I mean, parallelly, Toyota also does that. I think what we need to do as a country is that collectively we have enough charging points. I think that's where we need to reach, and hence we will see that there will be a significant partnership of private, and end of the day, public-private partnership where you will see a good number of charging stations available. Moving on, I think supply chain aspects we covered in the global slides, will not hit on it too much. But I think as Indian brands, you will see that we have enough overseas brands who have dependencies on getting the engines and other key components from their overseas companies. Okay, this is a significant player, and linked with this, your challenges around transport, where we saw a Red Sea issue or something else, which creates a disruption in your just-in-time availability of the key components. I think we have discussed that partially. Competition is a big aspect in India. As I said, India is a price sensitive market, and equally a big section is also ready to pay a few lakhs extra for luxury, and hence you need to have a flurry of products in your catalog where you offer the cheapest car as well as probably the most luxurious car as well. Okay. I think skilled workforce, I think that's a strength as well as issue with us. Somewhere, if we compare with other countries who are exporting more than India, I think we will see that while we have a significant, we are the most populous country, but probably not enough not enough efforts have been put in to ensure that the production quality and the efficiency are top notch. I think that is where India is somewhere losing its sharpness. I think we need to see if government or the companies invest time in training and upskilling their people to ensure that we don't miss out on this aspect.
Yes. The next is on environment-related matters. So like we said a few minutes ago, there is a lot of focus on ensuring that vehicles that are now being manufactured are sort of helping reduce the carbon footprint and are greener in nature. So I think most of the companies are now sort of inclined to have vehicles which meet these requirements, and that also helps build the entire goodwill feature of such brands within the market. When it comes to research and development, I think that is again an extensive cost that companies need to invest before they make any launch. On an average, what we've seen is that the development cost for any new vehicle is about 4 to 5 years. So you do have a conceptualization phase. You then do have a phase wherein there is enough market research done in order to see which segment the car should be launched in, what is the competition, what is the sort of price point at which a vehicle should be launched. And you then, after the research is completed, companies generally enter into the development phase where they actually sit down and draw a car, check to see what are the features it should have. And this whole process then requires even more time post the testing phase is completed. So on an average, we've seen at least 4 to 5 years are spent in this, and that does require a lot of capital investment in today's day and age. In terms of exports, I think while India is probably in the top 5 when it comes to exports within Asia, if you look at it from a global perspective, India is quite far behind. And that is more because there are a lot of other players in the world with larger manufacturing facilities, and those have helped them have better economies of scale and thereby increase the manufacturing and exports. So India, while the exports are increasing in recent times, there is still a long way that needs to be.
Yeah, I think the Make in India, I think Educate India, all these initiatives are helping. But I think if you compare with other countries like Thailand and others, I think there are still countries which are smaller than us, but probably are doing a little better or much better in some cases than us. And hence we see a lot of instances where we lose out on opportunities to some of these countries. And hence, I think now again, there is very little to pinpoint and say who is that one person or one thing which is responsible for this. It has to be a collective effort, which is not only Make in India, but also the ease of doing business, how we can make it simpler for both import and export and things like that. And I think all this collectively will have to be enhanced to ensure that we don't lose our shine. I think this is all what we had in terms of a general auto sector. We will now dive into, next slide, specific accounting topics where we can pick up issues. We'll pick up topics which we will discuss in detail. We probably don't see too many questions. There are a few, but we will answer them just to ensure that we are in a flow. We will go ahead with this conversation and then come back to the questions a little later. Yes, please.
Do you want to just check the questions right now before we get into?
So what sources do you use to keep yourself updated regarding industry, especially from a viewpoint of audit? I think you need to keep lookout for what are the new regulations which are coming in, which impact the sector. You need to watch out for CM data. What is that showing? What is updates from ARAI? Okay, I think these are good sources where it gives you insight into what are new regulations which are coming up. Anything else, Suvir, you want to add?
I think largely, I think just making sure that you're following the right regulatory authorities to make sure that whatever updates are coming in, you stay updated. And then that will help you check to see whether there is a financial impact and how it impacts your accounting. I think there's another question which is on financial impact in case of arising cyber attacks. So I think when we spoke about cyber attacks, we spoke about self-drive cars, autonomous driving, and the related cyber impact that could arise. Like Vaibhav said, I think this is not something which is prevalent in India because we don't have those technologies. But what it could possibly mean is that using cyber as a base, people gain access to your vehicle. And if that were the case, then obviously as a company, it could impact you because the vehicles that you are manufacturing are prone to, let's say, theft or access. You would know that if you've read about certain vehicles that are being manufactured by Land Rover rather. Certain Range Rover models are very prone to theft in the UK, and that is because it is very easy to access the vehicle and crack the security code to open it. So I think certain of these issues also then lead to a reduction in demand of your vehicles if they are prone to cyber attacks or any other such accesses.
I think sustainability related questions we will come back towards the end. We'll go with the flow of the sessions first.
Yes. So I think coming back to the slide, we do have about 8 separate topics that we would like to cover over the next hour or so. I think what we are broadly trying to look at is certain significant balance sheet accounts. So you would see we talk about property, plant and equipment, the related research and development expenses that an OEM or component supplier would incur. Certain instances where you would need to look at whether or not there is an element of leasing involved, right? Certain aspects with respect to grant accounting, like we said, there are a lot of subsidies that the government has come out with in recent times, be it PSI, PLI, and other such schemes. So a lot of companies have opted for these schemes, which has led to the accounting for grants. We'll then talk about inventories and some of the practical issues that we have seen when it comes to valuation, checking existence of inventories, etc. In terms of revenue recognition, because this industry is very prone to discounts as well as warranties, extended warranties, there are certain key elements that we would like to speak about. And in terms of costing, when it comes to price negotiations, how is the price factored in when it comes to discussions with vendors? Is there any compensation that is given to vendors for molds or tools or dies that a vendor would develop on behalf of an OEM? And finally, we'll talk about environmental related aspects or changes in regulations that have come up recently, as well as consumer litigations, because again, as you would be aware, the automotive industry is very prone to media coverage, to consumer litigations, because there are a lot of cases where retail customers turn out to be unhappy because of the nature of service or the quality of the vehicle that they have received. And that leads to either contingent sort of liabilities that the company would have or actual liabilities depending on the facts of the case. So coming to the first topic that we would like to talk about, which is on property, plant and equipment. What we've tried to summarize here is certain key aspects with respect to accounting for molds and tools and dies. You would be aware that most of the body panels of a particular vehicle are manufactured through use of molds and tools and dies, and a lot of internal key components as well, be it plastic, components, etc., also require the use of molds. Now, what we have seen is that when it comes to accounting for the cost of such molds, there are different approaches that different companies use, and this ultimately depends on the agreement that an OEM would have with an individual component supplier. The first sort of arrangement that we have seen is wherein molds which are manufactured and owned by the supplier are capitalized in the books of the supplier, but they are then reimbursed by the OEM through the part piece sale that the supplier would make to the OEM. So what happens here is that the initial cost of a mold is being incurred by the vendor, the supplier of a particular component, but obviously that investment has been made by the component supplier only knowing that when they do sell a part piece to the OEM, ultimately they will be able to recover the entire cost of the mold. So what becomes critical here is a review of the agreement to check to see, who is being compensated, if the vendor is being compensated, and the manner in which the vendor would be compensated. You also then need to look at the pricing of the component with the OEM in order to make sure that the appropriate prices as well as appropriate amortization of the molds and tools is being calculated and considered in the pricing of such components. Based on this, both at an OEM as well as the vendor end, you would check to see what is the appropriate accounting that needs to be done. The second sort of instance that we have seen is certain cases where while the molds are being manufactured by the component supplier, certain element of financing is being done by the OEM. Now, this again is prevalent in cases where you have component suppliers who are not that large, not that well to do, and which is why they require a certain element of compensation that would come from the OEM. Now, the OEM could agree to give this compensation in the nature of a financing arrangement. So it won't be an entire payment that the OEM would do. They would finance the vendor for a particular period, only to make sure that the immediate capital needs are being met. So what becomes important here is assessing to see whether the terms of the financing agreement could lead to an instance wherein these molds could get classified as assets that are on lease, and what is the appropriate accounting that you would do in that case. And secondly, since this is more in the nature of a loan that the OEM would have given to the component supplier, you need to check to see if there is appropriate hypothecation, etc., of the molds being done, because it is possible that ultimately in case the loan is not repaid, etc., the OEM could have a right to take back the molds. And the third and probably the most common manner in which molds are financed that we have seen at least is scenarios where the molds are being owned by the OEM itself, so that the OEM itself finances the mold upfront, but they are only lying at a vendor location. So from an OEM's perspective, this is a fixed asset that the OEM owns, but only practically it is physically located with a particular third party, which would be the vendor in this instance. So what becomes critical here again is checking to see the appropriate valuation, and this would be based on the cost that the OEM would have incurred to manufacture the mold. Secondly, as auditors, you need to ensure that these molds are physically available with the component suppliers, because even from a Caro perspective, you are required to report upon whether or not all fixed assets of the company are in existence. Have they been physically verified periodically? Is there an appropriate plan that the company has to verify all assets periodically? So it becomes important as auditors to make sure that you have due comfort on the existence of such molds. So you can use confirmations as a starting point to get a confirmation, an external independent confirmation from the suppliers. But it is always suggested that you also check to see if the management has due control in terms of physically verifying these molds on a periodic basis, just to make sure that the condition of the molds is appropriate and they actually physically do exist.
And I think as auditors, it is not a bad idea to once in a while go and inspect the tools as a part of your PPE verification. The objective would be to look at the physical condition. I mean, the mold assuming the third case where the mold is owned by the company, the OEM, you may be carrying it for a life of, let's say, 10 years, okay? And let's say it's 5-year-old as of today, but you don't know, will it really last for 5 more years, okay? While the model for which it is being used may still be in the market for 5 more years, But is the tool really in the condition that it will give you, it will serve you for another 5 years? Is a good assessment which is needed beyond physical verification, which can be done through other sources. And hence, probably an impairment testing and things like that may need a physical verification also. Again, depending on the cost, practicality, whether how far, how close is it, and other factors you have to consider it, assuming it is significant. I think it's not a bad idea to plan verifying it as well closer to the year end.
Yeah. I think some other key matters that we would like to highlight, and these are more from the point of view of internal control that the companies should have when it comes to the audit of PPE. Uh, the first is with respect to the entire vendor selection process when it comes to capitalization of assets. I think as auditors, we need to make sure that we have understood the vendor selection process that a company could have to make sure that there is no bias that the management can exercise in the whole vendor selection process. Auditing this is generally easier in an MNC sort of environment where you have, let's say, if you are auditing a company which has, let's say, approved vendors as part of, the entire list. In those cases, it is a little easier, but in the Indian environment, because we do also audit a lot of smaller automotive component suppliers, it is important to make sure that there is no bias during the vendor selection process, and each vendor which is being assessed in the selection process has been given appropriate weightage. Right. The whole objective of looking at some of these aspects is only to make sure that the costing that the company is incurring is appropriate, and also the fact that the company should ensure that they have received multiple quotations for the same asset from different vendors who are all independent to make sure that the best possible choice has been exercised and there is no bias, there is no element of misappropriation that could creep in because of any management bias. Another key aspect is with respect to investments that we see in terms of environmental compliance. We have spoken about upgradation of PPE that may be required in case of changing emission norms, etc. And I think this has become very critical in recent times because we have seen the government exercise changes in emission norms very frequently. So you would all remember that when the transition from BS4 to BS6 was happening, all OEM players at least assumed that there would be an extension that comes out from the government side. But we all know that towards the last minute, there was no extension that came out from the government, and that led to a lot of losses to OEMs in that particular month. So there were cases where inventories had to be sold at a significant loss. There were cases where certain OEMs had to stop production for a few days so that they could upgrade their facilities to start manufacturing vehicles under the new BS6 norms. And I think this is just something which is becoming more and more prevalent in recent times because both as governments as well as individuals, I think we are all becoming a little more focused when it comes to the environmental impact that we are having.
I think this aspect not only impacts the OEM but also component suppliers. I think who set up their own plant. We have seen numerous cases where this BS4 to BS6 transition has impacted a certain OEM supplier to really change the entire PPE line. Okay, the entire line was established to really cater to a particular type of product, let's say carburetor or things like that. And the moment the technology and the requirements change because of BS6 norms, they had to really revamp the entire line. Okay, and as you said, since people were expecting extension which did not come, people really looked at other opportunities, and I think they planned supplying to other countries close by, okay, in Asia where still BS4 was acceptable. Okay, so there were a good number of 2-3 years where what was produced up to a particular point in time for next few years was supplied. People took a lot of hit in because of impairment of PPE. And these are things which you need to be careful not only in OEM but also in OEM component supplier as well.
Yeah. The next couple of points are a little interlinked when we talk about valuation of specialized equipment as well as impairment assessment of certain assets. I mean, you are aware that the automotive sector is going through, significant changes in terms of technology. We have looked at, straight away internal combustion engines move to hybrid and now move to electric vehicles. This is again driven by consumer demand because consumers as a whole do want new technology, but they also want to make sure that there is appropriate mileage, lesser costs, etc. OEMs as well as component suppliers have invested a lot in these newer technologies, and a lot depends on how a new technology is sort of adopted or appreciated by retail customers. So if you do end up in a scenario where an OEM ends up manufacturing a vehicle but is not accepted or does not get the expected response from the market, then you do end up in a scenario where you need to look at impairment as a possible answer to the valuation related aspect of such PPE. So apart from just market acceptance, there are other things like economic slowdown, competition. We have seen certain OEMs invest a lot in manufacturing a new vehicle, but then you have, let's say, a compete such as the well-established players like Maruti, Hyundai, Kia come up with something which is significantly either cheaper or has certain better features, and that just leads to lower sales of a particular vehicle. You all know that when Tata did come out with the Nano, they did have a lot of expectations. There was a lot of capital investment that went in at that point, but because appropriate or expected market response was not received for the vehicle, there was a significant write down that was then required to be taken in the books. So a lot depends on how people respond to the product that is launched in the market. And as auditors, we always need to make sure that we are looking at market related factors as well to check to see if there is a possible rise that could lead to impairment in the books of the company that you are auditing.
When you're looking at impairment, I think it is important to note that management will always have budgets and plans which will normally be rosy. Okay, and as auditors, we should not look at only the rosy side. We should look at more practically, and maybe if needed, a little lesser than what management is. I mean, obviously much lesser than what the management is expecting. We need to put in an element of uncertainty to what has happened in the past. Look at that trend, okay, and not really look at the rosy picture, because I think impairment is one very difficult thing to assess in this sector, because there are so many factors which may not be existing today when you're taking a decision, which may come in later. And hence, while you cannot plan for all that, you need to be prepared, because this sector is known to have more changes come in much frequently than one expects. Okay, and hence that element has to be captured when you're doing an impairment assessment. And we cannot expect that in past 3 years, if we've been growing at the rate of 5%, we will continue to grow at 5%, provided there is, I mean, even if there is no change in the capex or investment in R&D and things like that, which may not happen. And hence, I think as auditors, we need to be careful in this aspect.
Yeah, yeah. And the last and important topic that we have is around product development. I think research and development expense is again something very critical that OEMs as well as component suppliers incur whenever there is either a new vehicle being launched or a facelift coming to the market or any new technology that could sort of impact the auto industry. I think as auditors, it is important for us to assess the management's estimates and assumptions when it comes to distinguishing between what qualifies as research and what qualifies as development. So Ind AS 36 specifically has certain conditions that need to be met with before an expense can be classified as a development related expense and capitalized in the books. I think as auditors, we need to look at all these conditions, the related conditions, as well as the internal control structure of the company before such decisions can be taken. We'll talk about research and development expense in a bit detail, because this is one of the key topics that impacts the balance sheet in terms of intangible assets. I think if we first look at the flow, the first thing that we need to look at is what are the accounting policies that the company is following. Whatever policies the company does follow, they should always be in line with the applicable accounting framework that we have. And like I said, Ind AS specifically has certain conditions that need to be met with in case there are expenses that qualify for capitalization. For any new projects that we as auditors look at, we should ensure that we are looking at adequate documentation. This could have, let's say, an adequate background research that the company would have done for a new product that they plan to launch, and what is the future feasibility of that product being accepted in the market. When it comes to an asset, you all are aware that the whole objective of a capital asset is to enjoy certain revenue in future periods. So it becomes very important to look at all these research related documents to make sure that there is, good feasibility of the product being accepted in the market, and there is a future economic viability of the product that will be sold by the company. So it is critical to look at all the underlying documentation that the management would have in this regard. For all expenses, it then also becomes sort of important to understand at which phase, they would get segregated from just being research, and which phase would they then move into the development stage. Now, as auditors, this can be done by speaking to, let's say, the R&D experts that the company would have, probably by speaking to key technical experts within the company to understand at what stage a particular project is, to see, whether it is actually in the development stage and whether there is certain development that is happening. And that would then give you a fair understanding of what are the costs that are being incurred and whether those costs could qualify as research or development related expenses. So in typical terms, I mean, what we've seen as part of R&D expenses, at least, when it comes to the capitalizable development expenses, what we have seen is that this could include manpower costs, because there are a lot of employees that the company could have engaged to design a particular product. So if you have an internal R&D or design center, you would have manpower related costs that are being incurred internally. But if you have engaged external experts or external design centers as well, you would have external costs that are being incurred. You will also have costs that are relating to prototypes that are being manufactured, certain testing that is required to be concluded before the product can be finalized and launched. There would be certain iterations of the same product that are being manufactured, getting customer acceptance before they get into the entire series manufacturing process. So these are all costs that you would need to look at, vouch, understand the nature, and check to see whether they are appropriate or not. Based on this testing that you would do, you would then arrive at a particular value of the development cost that is then required to be capitalized. I think once this entire capitalization is completed, you will then have a periodic assessment, reassessment of impairment to check to see what is the future viability again of this product, and what is the life cycle over which you expect to recover this development cost. So I think based on these audit procedures, you should then be able to conclude whether or not the R&D expense has been appropriately accounted for. Again, to sort of clarify, research-related expenses are generally expensed out because that is only a research phase. You're not actually developing any particular asset relating to a particular product. But when it comes to a development phase, if the conditions are met, you could then be in a position to let the capitalization happen.
But I think it's very easier said than done to differentiate between a research and a development, to really draw that thin line in an entire chain of events which management may be doing, to call it, to say up to this point it is research and probably after this point it gets into development mode. I think this is very difficult, very judgmental, and it changes from organization to organization. Internal costs which can be capitalized, I think as auditors, we obviously have to be very careful when employee costs and things like that are getting capitalized, because you should be sure, I mean, because you don't know what all projects those employees have worked on. Is it a particular project that the client may have its own R&D team, which may have, for example, 10 employees. Are all the 10 employees at a point in time working on one project, or are they working on more than one project? What is the stage of each project? Has it crossed the research phase, or is it still in the research phase, and hence it should be charged off? I mean, these are questions which raise a lot of, there are a lot of questions which get raised in such scenarios. And hence, capitalizing an internal cost, unless you're very sure that it is reached a development phase, is probably the key decision to really take. And that assessment has to be done by the auditor when you're auditing the capitalization of development cost as R&D cost.
Another key aspect, like we spoke about, is with respect to leasing arrangements. I think this becomes more important when we are looking at scenarios where you have vendors who are, supplying a large portion of their produce to a single OEM, or you have vendors who are specifically dedicated to manufacturing components only for a particular OEM. I think the assessment that needs to be done in this case is if you do have, majority of a supplier, or you do have, let's say, a sole supplier, whether or not the OEM has the right to obtain, most or substantial part of the economic benefits of certain capital assets that the component supplier would have invested in. So the objective here is to check to see if there are any specific capital assets that a component supplier would have invested in or procured in order to manufacture components for a sole customer, and the customer could be an OEM in this case. How do you account for such assets? Now, under the leasing standard, you would see that if there are such assets that a component supplier has capitalized in their books, if they do meet certain conditions, there could arise a situation where those assets need to be treated as leased assets by the OEM, which means they are right to use assets which need to be capitalized in the books of the OEM. So it becomes very crucial to look at all supply agreements that both component suppliers have as well as OEMs have, just to make sure on what are the arrangements in terms of supply, what is the capacity, the installed capacity that a particular vendor has, what is that portion of supply which is being given to, let's say, a sole customer, and that should then help you decide on whether or not there is a particular impact in terms of leasing. And if you do go down that path of leasing, then obviously there is a need to look at impairment as well, because that would then depend on what is the OEM's capability of picking up the entire produce and what is the sort of market demand that you have.
But I think being a sole supplier is not the only factor to consider it as a leasing arrangement. I think it is, we have to look at other factors also, which are like risk and rewards. Probably as a sole supplier, if the supplier is taking enough risk in terms of having his own money, and that if he's carrying that capex risk, then I think you can always conclude to say there's no need to consider this arrangement as a lease. I mean, I guess if you guys want to explain, if you are a sole supplier and you are concluded as a lease arrangement, then the OEM will have to capitalize all your capex. So imagine the supplier's capex not shown as capex in his books, but has been shown as capex in the OEM's books, and the supplier then eventually becomes only an agent who's probably just earning a markup or a margin on that aspect, because the entire risk belongs, the entire capex, and even if he's not incurred it in his name, but the entire risk is taken up by the OEM, in which case the ownership of that asset will lie in the books of the OEM, and the supplier will probably only be earning a margin. He'll only merely be a agent and not a principal, right? So those are the implications of the standard, and hence we needs to have a critical assessment. And only being a sole supplier or supplying maximum quantities to one OEM may not be the factor. You'll have to look at other economic aspects as well to conclude on this aspect.
Yeah. The next little topic that we have is with respect to grant accounting. I think, like I mentioned a little while ago, there are a lot of PSI, PLI related schemes that we have seen in the past. The whole objective of these schemes, at least from the government's perspective, is to sort of boost manufacturing in certain areas. And at the same time, a lot of these schemes also have employment related conditions that are associated with it. So while OEMs do get the benefit of the grant, they do need to make sure that certain conditions with respect to employment or a minimum capital investment is also achieved. And that thereby helps, fuel the economy, as well as make sure that there are adequate jobs that are being created in such areas. So I think what is critical in this case, the first step obviously is to look at the management's assessment as to whether the grant is, capital in nature or revenue in nature. This again would depend on the conditions that come associated with the grant. So as auditors, it is critical for us to look at the eligibility letters that come in from the related authorities to understand what are the terms, what are the obligations on the company as a whole, and that should then help you conclude, whether or not this grant is capital in nature or revenue in nature. Depending on this classification, your accounting will change. The next thing that you need to look at is, when it comes to initial recognition, is the manner in which you value a grant. So let's say you conclude that a particular grant is capital in nature, and there is a particular amount which then needs to be recognized in the balance sheet. The key question is, how do you value such balance? generally what we've seen is that in this scenario, there are a lot of forecasts that come into the picture, because you need to check to see what are the revenue forecasts that the company will have. Based on those sales forecasts, what is the amount of grant that the company would earn on a year-on-year basis? And you would then discount that to arrive at the net present value of the grant that you need to record in the books. It's also critical to check to see if there is any risk factor that you want to look at in this, only to sort of protect the books from any possible risk of future impairment. So, like Vaibhav mentioned, any company at any point wants to paint a rosy picture when it comes to forecasts. They do want to have the best of forecasts, because as management, they are very optimistic whenever it comes to sale of products that they have manufactured. But as auditors, you need to be a little skeptical. You need to look at, what is the actual direction in which the market, the industry is growing, and what is probably your specific companies or clients share in that market, in order to get some understanding of what could be the possible forecast. So looking at prospective financial information is critical, and also looking at key assumptions like the discount rate, etc., also become important to enable you to value the grant initially. On a year-on-year basis, as auditors, you're then required to look at the management's assessment, reassessment of the balances, to see if there is any significant change that is coming into the picture because of changing forecasts. So if you do look at, let's say, your grant balances 3 years down the line after initial recognition, and you notice that there is a significant deviation between what the company management had forecasted vis-a-vis the actual sales that you have seen over the last 3 years, you may want to question the management to check to see whether there is any need for impairment, and whether or not the assumptions being used are appropriate. So the need for taking a market risk factor, a sort of reduction in the forecast that the company is taking, that may arise, and accordingly some accounting may need to be done.
And I think there is no reasonable period to really say that it should be done once in a year or once in 3 years. I think it is very fluctuating. I think depending on how some of these factors play out in the real life, it may be fair to say that such assessment should be done at least once, from an company perspective, that every year when you're doing an annual audit, you may not want to test it in each quarter, but you may have to surely test it once in a year. For example, if you assume certain sales will happen in the next 3 years, and probably the last 2 years sales have not followed that trend, you may not want to wait for another 3 years to really see that yes, those targets are not being met. The past trend of last 2 years should be used to recalculate or re-estimate your future sales for next 3 year balance period of the capital grant's life, which you have assessed. And I think it should be downsized accordingly. I think this has to be done more frequently, at least once in a year, if not, unless the factors require you to do it much more frequently than that.
We'll then move ahead to the next topic, which is around inventories. The next 2-3 slides or so are around certain key aspects with respect to inventories. So what do we mean when we talk about inventories? So if you look at the right, I think what we are talking about is production related inventory, which includes your raw materials, spares and components, other supplies that may be required in the manufacturing process, and your work in progress balances. You then have finished goods, which are largely goods that have been manufactured completely, and they are ready to be sold. You do have inventory that is held for service or maintenance contracts. In today's day and age, maintenance contracts have become very popular in the automotive industry. You would see that a lot of OEMs, dealerships are pushing for maintenance contracts to be sold along with the vehicles. And the whole reason for that is obviously to ensure that once the vehicle is sold in the retail market, you do have customers who are coming back to your authorized dealers for the maintenance bit. The last part that we have here is then with respect to goods in transit, where you have either inward or outward goods that are in transit, which broadly have not met the sale recognition criteria in case it is an outward sale. So what are the challenges that we have here? So there are 3 key aspects that we want to talk about. The first obviously is how do you value inventory correctly? So each different category of inventory, how are you valuing that appropriately? The next is how do you look at provisioning of inventory when it comes to either inventory that is slow moving or inventory that may turn out to be obsolete? And the third is, what do you do in cases where there are any discrepancies or shortages that have been noted during the physical verification process? So in terms of valuation of inventories, if we talk about raw materials specifically, I think the standards require companies to value inventory, raw material inventories at cost plus any costs that have been incurred to get the inventory to its present location. Now, this could include, in addition to the cost of material, it could include non-refundable duties. Let's say if you have goods that are being imported, you would have a certain element of, let's say, basic customs duty, cess, etc. You could also have inward freight, etc. So all these costs, the basic cost plus such costs, would then lead to whatever is called the landed cost of goods. Method of valuation can differ. We have seen certain companies using FIFO as a method, and certain companies, or I would say a larger portion of companies, using weighted average as a method of valuation of inventories. But it is critical as auditors to make sure that you have appropriate data that helps you look at whatever is the weighted average cost, the recalculation of weighted average cost based on the landed cost of purchases that you then have. When it comes to looking at work in progress or semi-finished goods as well as finished goods, you know that in addition to only material costs, this also includes certain portion of overheads. So how do you look at material costs? So to look at material costs, you need to make sure that you're looking at an appropriate bill of material, which would be the BOM in this case. As auditors, it is critical to look at whether or not the bill of material has been approved by the right authority, and there haven't been any unauthorized changes, etc., that are happening to such BOMs. Against this BOM, you would then need to look at what is the most recent material cost, and which is why looking at the raw material portion also becomes important in this case. In addition to material costs, you would also look at the overhead related calculation. So I think one common error that we have seen during our audit of auto clients is that companies generally tend to overvalue their inventories by including certain irrelevant non-direct manufacturing related costs in the overhead calculation as well. So I think standards specifically require us to look at only costs which are direct in nature. These need to be directly related to the manufacturing process, and only these costs can then be capitalized on the inventories. So I think it's critical for us to look at what are the underlying costs that are being used by the management in the overhead calculation process. If you do have an ERP which is carrying out this valuation activity, as auditors, it is important for you to understand the logic that is fed into such ERP. This testing is something, you could understand independently yourself if you do have the required knowledge, or if you do involve, let's say, an IT expert to help you with such testing. That should then help you get some understanding as to how costs are being considered when it comes to overhead valuation.
I think equally we have seen scenarios where clients for ease are not capitalizing overheads. So one is a situation where you overvalue your inventory. Similarly, there are people who would say that I would not want to value load overheads and probably keep my SFGs or WIP valued at RM itself. Okay, and probably at times it is immaterial, and hence auditor could ignore it, but not always is it immaterial. And hence, I think as big an issue is overvaluation inventory, equally as an issue about undervalue of inventory, because in both situations there is as an auditor, we are not only certifying one side of the profit. We have a concern if profit is understated or overstated both, and hence as auditors we should be watching out for such situations. And unless immaterial, we should not leave such. We should probably ensure that inventories are rightly valued. I think the best part of auto, if you are doing auto industry, is if you're doing an OEM, I think you can very clearly draw the sequence of events in which an inventory is built up. I mean, you can really say how a car starts from a particular first part and end of the day moves step by step. I mean, most of the times the steps are so clearly defined that a third step cannot happen without the second step happening, which I think the challenge is to reach that level of understanding where you know what is this critical path. And once you have updated your knowledge or gained understanding about it, I think then the valuation of WIP and FG and SFG becomes very easy, because then it's only a challenge about knowing at what level is that inventory standing as at the year end. I think if that is established, it is not very difficult to ascertain the value For example, if the car is before the paint shop, then so many things are already done or loaded on the car, and hence this should be the value of the WIP. Probably if it has crossed a particular stage and the final painting is done, then you know that I think almost everything is done on the car. I'm just giving you some random examples. So once you get to know what is this critical path, and I think then valuation of these WIP and SFG becomes very easy. Otherwise, I think one can always say that it is very difficult to value inventory.
Yeah, yeah. The next is around inventory obsolescence. So again, auditing this is a little challenging because it relies a lot upon the availability of data. I think what is critical for us here is to first check to see if we have an aging of inventory that can be provided to us by the management. So that's the first step for us to check, whether or not there is any inventory that is slow moving or which is not being consumed as per plan. In case you do not get data with respect to the aging of inventory, then the next alternative that we generally use is to look at consumption related data to see which are those parts of inventory wherein the consumption is probably very low during the year, where you probably see only, let's say, 5 or 10% of consumption of the opening inventory. So that should then give you a question, will say, as to why a particular part is not being used. And these parts are, again, raw material and components that we are talking about. And when you're looking at WIP, SFG, or finished good balances, there again, as auditors, you should check to see if there are any items of finished goods or WIP which are part of opening inventory, which the company has not been able to sell during the year. These are all indicators of inventories that could be slow moving in nature. What becomes critical in the auto sector here is looking at any specific inventory which has turned out to be obsolete. So I think one example that we have seen over the last 5-7 years is the BS transition that we've seen. So we saw BS4 to BS6A, and very recently, last year, which is April 2023, we saw the transition from BS6A to BS6B as well. I think in both such transitions, we have seen that there has been a significant portion of raw material as well as finished good inventory that OEMs as well as component suppliers have had. And there have been instances where OEMs have had to give significant discounts to the market at large to get rid of older inventories. So it becomes critical for us to look at the NRV of such inventories, only to make sure that the realizable value of inventories is higher than the value at which you are carrying it in books. In some instances, because the discounts being offered by OEMs have been so significant in the market, we have seen that there is rise. There has been an instance where NRV provision was required to be recorded. So as auditors, again, you need to look at market data as well to see if there is anything critical that gives rise to a need for inventory obsolescence provisioning in the books of the company that you are auditing. What is also important is checking to see if there are any associated costs that a company may need to incur in case they have old or obsolete inventory lying in the books, because you'll then need to factor those costs as well when you're looking at the need for inventory provision. The last critical assertion that we have for inventories is with respect to their existence. And I think when it comes to looking at the management's process from an internal control perspective, it is important that we understand the process that the management has in place to do their periodic physical verification of inventories. So as a practice, companies could have a periodic system of physical verification, or they could choose to have a perpetual system of physical verification as well. Irrespective of the manner, I think what is critical is that when we look at this verification being carried out, there should be due segregation of duties between the person responsible for managing inventory and the person responsible for conducting a physical count of such inventory. This cross-function check generally helps identify any discrepancies, and as management, that control is then put in place effectively if they can have a cross-functional team member come and verify inventory on a periodic basis. We should also check to see what process the company has in place to verify or at least get due confirmation of inventory that is lying with third parties. So there are a lot of instances where we have seen OEMs sending certain components to third parties for a machining process or a certain pre-production process that could happen at a certain vendor. But at a period end, it is critical for us as auditors to make sure that there has been a physical verification, or we have at least obtained independent confirmations from such third parties for inventory balances that align with them at the year end. And the last most important bit, which impacts both your inventory balances as well as revenue, is the cutoff related procedures. When it comes to both inward inventory, which is your raw materials or traded finished goods that you would have in transit, and when it comes to goods that have been sold at the period end as well, it is important that due cutoff procedures are performed to ensure that revenue recognition and recognition of purchases is happening appropriately. So you do not want to have a situation where revenue that should not be recorded in the current period is being recorded by the management, and accordingly your inventory is also understated. You need to look at revenue terms critically to understand what are the revenue arrangements that the company has in order to make sure that revenue as well as inventory and consumption related balances are recorded appropriately.
I think in terms of existence of inventory, we should also be mindful that if you are talking of an OEM, let's assume 31st March as a scenario, which is your year end. Not always will an OEM agree to stop production to ensure that you do a physical count, as at the auditor or the management themselves do a physical count on 31st March. Okay, and hence there will have to be enough discussion with the management to plan what is the right time, if not at year end, very close to the year end, when you can do a physical verification. And in case there is no stoppage of production, what is the best alternate to really identify or arrive at the closing inventory? FGs is easy, RM is easy. I think the problem will be around SFGs and WIP. How would you identify at what stage is a particular inventory? If production is not stopped, then yes, I think there is an element of judgment, and you will need management and auditor to work together to really understand and identify and document what was the stage at which that inventory was. I mean, we have seen in practical scenarios where practical solutions could be worked out, which should be acceptable. But yes, I think it is something which has to be planned, and auditor cannot just say that it is a continuous plant and it cannot be stopped, and hence physical verification cannot be done at or near year end. I think it's a very critical CARO expectation or a CARO reporting matter as well, that physical verification is performed by management at or near the year.
We then come to certain items in the profit and loss account. We'll start off with revenue recognition. Again, here, when we talk about sales in the automotive industry, in addition to the sale of products that we do have sale of services and certain other specific matters. So sale of products generally talks about, the vehicle sales that you would have. When it comes to automotive components, you would have sale of related parts and components. What we've also seen in OEMs is a growing trend of OEMs entering into the used car business as well. So there are a lot of OEMs that have now entered into the used car business through their dealerships in conjunction with their dealerships, and that is in order to ensure that they have a better reach in terms of saleability of their products. We also, when you look at sale of services, in addition to the after sales service that companies could offer, you have cases of extended warranty as well as maintenance contracts that we spoke about. There are also certain other arrangements that we have seen happen. So we have seen certain licensing and royalty related arrangements that OEMs could have entered into with other partners for any publicity or let's say marketing that an OEM would do for certain products on behalf of other companies. And finally, we have also seen certain sale of merchandise. We have seen sale of R&D services largely, and these are more intra-group that we have seen. So R&D, let's say a company that has set up an R&D center in India is providing R&D services not just to an Indian entity, but also to, let's say, a holding company or a company that is sitting outside the country. So largely, these are the different streams of revenue that we have seen in the automotive sector. And each of these streams comes with their own peculiarities in terms of accounting, revenue recognition, as well as related aspects. So what is critical, I think, from an auditor's perspective is to look at first understand what are the streams of revenue that the company has, the company that you are auditing, And for each of these streams, it is important that you understand the process flow. Look at key contracts to understand what are the key terms that the company may have with its various customers, and accordingly check to see how that fits within the whole gambit of the accounting standard that we have. You also need to look at the manner in which revenue needs to be recorded. Is it at a point in time, or is it over a period of time? Again, depending on the terms and conditions that each of these contracts would have. There are certain other elements as well, for example, incentives and discounts, and that's something we'll talk about in the next slide as well. But a lot of incentives and discounts that we've seen in the auto industry, more in the OEMs that we audit, have an impact that goes to revenue, right? So because these discounts are significant, they do have a significant impact in your revenue account. But I think what we should also keep in mind is the fact that for any quarterly reportings, or let's say interim reportings that we look at, where certain accounts discounts are accrued on an estimated basis, we need to make sure that we are looking at the underlying management assumptions there, so that there is no under or over accrual. So I think, like I said, largely what you need to look at is look at the contracts, understand the terms in order to make sure that revenue is recorded appropriately. And like we spoke about in the inventory section, I think looking at cutoff related aspects is very critical. There are some audit procedures that can be performed assuming that you have access to good quality data from the client that you are auditing. But in today's day and age, I think at least what we've seen is most of the companies are using good enough ERPs, and those ERPs are helping us get the right set of data. So I think with the right set of data, it is possible for us to look at data in a more detailed manner, and that gives you a larger comfort on the audit that you perform. So I think what we generally look at from an analytical perspective is extraction of, let's say, a sales register from the ERP, using different dashboards, for example, a Power BI based dashboard. As auditors, you can perform various analysis to look at what are the kind of sales, do a comparative analysis of sales either on a quarter-on-quarter basis or a year-on-year basis. Make sure that you're doing appropriate segmentation of data to look at customer-wise sales. Are there any trends that you should be aware of? Is there anything unusual that is coming up based on your review of segmented data? You can then look at the pricing. How has the price fluctuated? How has the price of all sales moved during the period that you are auditing? Does the increase or decrease in prices also correspond to the underlying contracts that you have verified? Does it correspond to any market information that you have? For example, you read a news article about an OEM increasing or decreasing its vehicle prices. Does that correspond with the kind of data that you are reviewing? I think that's also a critical aspect that you can look at. And then eventually you can look at what is the sort of market sentiment based on information that is available publicly to understand what is the response that the retail market has to a particular launch. We have seen instances where new launches have had a lot of consumer complaints, and consumers have been very vocal about these complaints on social media. That should then give you an understanding of probable warranty costs that will come up, how such feedback could impact the future sales of the company. These are all inputs that can help you have more deeper conversations with the management to understand how this can impact the numbers of the company. In terms of discounts and rebates, I think, like I said, the automotive sector is very prone to significant discounts in a cyclical manner. You would have all seen that when it comes to discounts on vehicles, at the start of the year, you may not see a lot of discounts, but as the months progress, the discounts only increase. That's also in line with the festive season that we have in our country. So you will see that the last quarter of the calendar year generally has higher discounts because that's when people generally tend to buy vehicles. But a lot of global players also come up with discounts in November, December, etc. And that's because MNCs follow a Jan to December accounting cycle. So in order to meet their calendar year targets, companies do come up with a lot of discounts towards the end of the year. Now, as auditors, it is important for us to make sure that accruals for discount are happening on a periodic basis. So if you review the contracts that a company could have with its dealers, you would need to make sure that you have a good understanding of the terms and the conditions that are associated with each of these discounts. You would need to look at the monthly or quarterly discount policies that an OEM could come out with. So we have seen that you know, there have been instances where, you know, there is a new discount policy that has been rolled out every 15 days as well during the year. So it becomes very important to, you know, correlate which discount policy was applicable at which period during the year, because whenever you're doing your testing, you need to make sure that, you know, the right set of discount has been applied against a particular sale. So whenever you would do your substantive testing of sales invoices, you would need to look at what was the applicable discount and whether or not the right amount of discount has been passed on to the end customer. So it becomes important to look at the discount policies both from an accounting perspective for what has been passed on, as well as any accrual that is being made for, you know, let's say quarterly or year-end targets. So in case there are annual targets that are set for dealers, you need to ensure that the accounting that the company is doing, let's say on a monthly or a quarterly basis, is being done using a fair estimation of what could be the ultimate discount payout for the entire calendar year. So these are all estimates that the management would sort of have in place, but as auditors, you need to look at the feasibility and appropriateness of these estimates and whether or not, based on your past history, past experience with the entity, whether or not you feel that dealers will be able to meet those targets and what could be the possible payout of discounts for the year. So all that should help you in validating whether the accrual of discounts is appropriate. It is critical for us to remember that you know, most of the discounts that we see impact the revenue account directly, and if there is any sort of manipulation that the management would want to make to the revenue account, it could also happen through the discount accrual process.
And I think it is critical here to, I think, as Suvir said, because it directly impacts the top line, it is very important that due focus is being given to ensure completeness. And while you will agree that I think an audit normally happens in a best scenario, probably could be 30 days from the year end to as late as 3 month, 4 month in case it is a private company. I think as an auditor in an auto sector, it is very critical that you look at the subsequent events more critically to get some comfort out of what has really happened. I mean, the farther you audit after the year end, that's the maximum time available to really look at subsequent events. That much should be the rigor, higher rigor which the auditor should use to draw some comfort around how has these negotiations finally been concluded, how much discount benefit has been passed on to the dealers, okay, and to ensure that the discount given probably even after the balance sheet date, how much of it really relates to sales which were made up to 31st March or the year end and have been accordingly pulled up to 31st March. I think these are all critical evaluations which need to be done. And I think, yes, I think even if the company has an objective of achieving certain target, I think as Suvir said, while you may not be able to alter significantly the sales data because it's very factual, but I think these are instances or these are opportunities or avenues where the numbers could be altered knowingly, unknowingly. I mean, you really don't know, and hence it has to be that much more cautiously audited.
Yeah.
I think just before we dive here, I think you talked about certain services which you render to global parent, which could be on cost plus markup basis, etc. I think just because it is an intercompany sale, you should not take it at face value. You'll have to understand whether there are one arrangement or multiple arrangement with different ultimate customers who all could be your owners or primary or what do you call the parent companies or subsidiaries of parent companies or other related entities. But I think if the markup is different, then you need to have and you need to ensure that as auditors you have comfort around the cost segregation at a cost center level so that the cost is aggregated. Let's say you have two customers whom you charge at cost plus 10% and cost plus 12% for certain reasons. I think then you need to ensure that the right cost is captured under different cost centers, or management has a good process to identify how the right cost is accumulated for the first customer to charge at 10% and for the second one at 12%. I think I mean, this has an ICFR impact, this has a revenue impact, it has a tax impact, and there's a fallout into transfer pricing. And I think things just go on because it's a related party transaction. So I think while it could be a very small area, but you need to be cautious and depending on the materiality, again, ensure that there are enough controls which management has in place to really ensure completeness.
Yeah. The next critical topic in the profit and loss account obviously is with respect to warranties. Like I said, new launches, again, there are a lot of cases where we see new launches have a lot of complaints, and it's expected because a new launch is always expected to have certain complaints in the first few months, because that's when you have a full-fledged testing being conducted by, all your new customers. So as companies, it is important for them to estimate what could be the probable warranty outflow for a car. But as auditors, it is also important for us to see what are the key estimates that the management has used while arriving at the warranty provision that needs to be taken for each vehicle that has been sold. It is critical for us to look at past data. In this case, to look at what has been the general trend of claims and what has the general trend of the actual cost been when it comes to warranty claims. In case of, let's say, new launches, it is a little more difficult because you don't have any corresponding or comparative information that you can use. But you can always, look at the management estimates, look at comparative information that, let's say, Compete could have for a vehicle that is in a similar segment, to look at what is their average warranty cost, etc., to give you some indication as to what could be the appropriate warranty costs in the company's books. So it is critical that you look at how the warranty provision is being valued. Ideally, it should be, the quantity of vehicles sold multiplied by a particular cost that has been derived by the company. But it's also critical to look at the past claim related data in order to understand what is the actual cost that the company is incurring against the provision that is recorded in the books. Again, this is a critical estimate, and hence all assumptions that the management has taken in this calculation need to be validated. Again, availability of data is critical in this case, so it's always recommended that we do a due diligence when it comes to historical data that we are reviewing with respect to warranty. Some analytic related procedures that we can do, and that's generally looking at claims by location. Claims by location is important in our country because India being a very vast country, we have seen certain vehicles respond differently depending on the geographical location of such vehicles. So you could have a vehicle which is functioning perfectly in the state of Maharashtra, but certain vehicles have had a lot of complaints while being used in the northern states, and that's because the temperature, altitude, etc., are different in such states. So we did have a scenario a couple of years ago where we had seen an OEM sell a certain vehicle, but because of extreme temperature conditions in the north of India, there were different set of warranty claims that were coming into the picture. So geographical data is important for India as a country. Another process that as auditors we can perform is to check to see what is the general lag within which a claim is received by the company, a warranty claim is being received, and an actual settlement is happening. That could give you a fair understanding of how soon a claim is going to be settled, and what is the kind of provision that should be kept in the books based on claims that have been received till date. This should then help you get a fair understanding of the costs, the utilization of the warranty accruals, and the appropriateness of the balances that are being stated in the balance sheet.
I think on the warranty side, it is important to really also assess how much of the warranty cost belongs to the OEM and how much of it could be passed on to the OEM component supplier. Let's say a particular component is purchased from a supplier, I think, and if that part goes bad, it again goes back to the arrangement with that supplier, where as to who takes the risk and rewards. In a leasing, if you go back to a few slides, you will remember there are situations where the entire capex is practically owned by the OEM, and the supplier is merely supplying, manufacturing is supplying certain parts, and he does not carry any risk and rewards of warranty. Okay. Contrary to that, if there is a supplier who has a big responsibility to even uh, give you a replenishment for the bad parts which come up during the warranty period, it's a big indicator for your leasing conclusion as well. And hence, I think you will see that some of these areas may not be connected directly, but may have an interplay into when you take certain decisions. So I'm just trying to link, I mean, if you guys understand how a leasing thing can get linked to a warranty question, and this could be one more factor beyond you being a sole supplier or a supplier being a sole supplier to an OEM, but not considered as a lease because you take enough or the supplier is taking enough risk and rewards on his own to really honor that commitment.
The next important topic that we have is with respect to vendor pricing. This again becomes critical because this gives us a fair understanding of how a company gets into arrangements with their vendors, either for components or for any other critical parts that they see. In the first slide, we spoke about molds and the various arrangements that a company could have when it comes to compensating vendors for the cost of the molds. I think that's something that we need to look at in conjunction with PPE. So we ideally, as auditors, we look at what is the arrangement that the company has when it comes to compensation for molds, and if based on that you believe that there is a certain portion which needs to get factored into pricing of each component that you purchase from a vendor, you need to audit those numbers just to make sure that they're flowing appropriately from the relevant workings. One thing that we have also seen is that long-term agreements generally do have clauses with respect to periodic revisions in the pricing. And pricing of this component, while there may be an initial agreement that an OEM could have entered into with a component supplier, there are a lot of external factors such as changing index of key metals, etc., which could then lead to the need for revision of prices. So it's critical as auditors for us to review these agreements that we have with between OEMs, component suppliers, and other parties to check to see what are those factors that could lead to a possible revision in prices. And if those situations do arise at any point of time, there should be an appropriate accrual of the price differences. So working on these aspects is a little difficult because it does require availability of historical data. It does require a lot of negotiations that happen between an OEM and a supplier to agree upon what portion is going to be compensated by an OEM to a supplier, and which is why it's important for us to look at all the underlying documentation, understand what is the current status of discussions between vendors, suppliers, and OEMs, whether there is any correspondence that you can review as auditors, whether there is any discussion that is ongoing, for which you can get probably minutes of the meeting or understand, any email correspondence that has been shared to get a fair understanding of what are the claims that a company would have received. So I think these are all documents that you need to request for. It's not easy to get most of these documents because a lot of these conversations are confidential and they're not shared with the auditors. But you need to understand that these numbers can be very material because the profit and loss account, material cost is a very significant portion. So any slight change in the pricing could also have a cascading impact on the P&L margins, etc. So it becomes important for us as auditors to look at all these aspects.
I think client will be, as you said, in the name of confidentiality, not wanting to share a lot of stuff. I think there has to be an appropriate balance which you need to agree with the client, wherein super critical information need not come onto our files, and probably we need to ensure that it is probably at least seen by us, and if not, a copy is taken by us. Okay, there's a lot of comfort. I mean, we have done this practically where clients have shown us on their machines what is the actual negotiation which is going on with certain suppliers. Okay, and but because it has certain critical information which may be sensitive to a business and you don't want it, I mean maybe the client is not very happy giving it away and hence not sharing a copy, but it is always a good idea to at least cite it, okay, and take some comfort about the fact as to what are the actual discussions which are happening. There may be situations where clients may say that certain negotiations are not concluded and they're still ongoing, and you may have to still sign off a particular audit at that point in time. It is good idea to really go back and understand what is the level of conversation, even if it is on emails, what is that email exchange happening, what is the prices which are being negotiated. I mean, you don't want a situation where your accrual is 50, a payment of 50, but negotiation is happening between 100 and 150, and you will settle somewhere between that. It clearly indicates that your accrual is under accrual, or vice versa, whatever the case may be. You don't want as client to accrue more, wherein the negotiation which is happening is for a range which is much smaller, right? So while, and hence, I mean, just because the agreement is not finalized or it is not concluded, you should still go ahead and ask for to look at minutes of the meetings and copies of the ongoing negotiations, which will give you a good idea about your accrual process.
Last 5-7 minutes before we head into the Q&A.
Q&A, yeah.
So we have just two topics. We will briefly touch upon environmental obligations. I think we've spoken about this in the first few introductory slides. But I think what is critical from an accounting perspective is checking to see what are the regulations that are applicable and what are the possible liabilities that a company could have. I think one critical recent update, like I said, was with respect to the CAFE norms, the corporate average fuel economy norms, which impacted the automotive sector with effect from December 2022. What this does require is every OEM manufacturer within the company to make sure that the vehicles that they are manufacturing are of a certain fuel economy. In case, companies do not have fuel efficient vehicles, then there is a penalty that is levied on OEMs. So, I mean, this is one example. There are numerous such regulations that are applicable to companies in the auto sector. We need to stay abreast with what is applicable, what are the changes that are coming in from a regulatory standpoint, and how these impact the company, and whether there's the need to pay any penalty, or is there a need to accrue for certain costs that could be incurred in the future. It becomes critical for us to look at all such aspects to ensure that liabilities are stated appropriately in the balance sheet. I think one thing that can also be done as part of our environmental obligation check is to look at any ongoing proceedings. So in case there are ongoing litigations that have come to the company through authorities like the NGT, the National Green Tribunal, you can always check to see what is the status of these proceedings and how it could impact the company that you are auditing.
And I think obtaining confirmations from lawyers, or if there are legal retainers, I think obtaining periodic confirmations from them about ongoing cases is a good idea. And I think if there is an internal legal team, then I think asking them to ensure completeness of all ongoing cases. Otherwise, very difficult to really know what other obligation is fallen onto the company. It's easy to track direct tax and indirect tax cases, but some of these cases may not be very easy. These regulations may be specific to auto sector, and I think it may not be very easily identified at the right time. Okay, and hence to ensure that you are accruing it and you're not missing it out at a particular point in time. You need to ensure that you take updates from management and experts like the legal experts and others to ensure completeness.
Yes. And the last topic that we would like to talk about is with respect to consumer litigations. Now, the auto industry in general is very prone to public scrutiny, because it's easy to blame a car manufacturer in case anything goes wrong with the vehicle. What we have seen is that there is a range of consumer litigations that can happen on a company. So there are complaints that go against dealerships when it comes to delivery of vehicles or servicing vehicles. There are complaints that go against OEMs as well, because probably there are manufacturing defects that have come out, or the quality of vehicles sold has not been up to the mark. We have seen in recent times a lot of complaints from retail consumers come up on social media, and those have negatively impacted the performance of companies as well. There are certain models of companies that do get impacted based on the kind of reviews that come out on social media. So it's always important for us to look at the kind of complaints that have been received by the company. And at the same time, it's also important for us to sort of be a little practical when you look at the amounts of claims that are involved. We have seen a lot of frivolous cases as well, where retail consumers have come up with extravagant demands for compensation only because the vehicle, mental duress, mental torture, using those as sort of reasons to claim crores and crores of rupees. So as auditors, you need to be a little skeptical when it comes to accruals that a company may want to record for such ongoing litigations. You can't always, be comfortable with recording a provision for the entire amount of ongoing litigation, but you should also look at things, look at the facts with respect to each of these cases, look at past history to see how similar cases have been settled and what has been, the average outflow of the company when it comes to settlement of such cases, and using that form a base as to what should be the right amount of accrual or disclosure that needs to be given in the book. So a lot of such litigations form part of contingent liability disclosures, but some of these, or a portion of these at least, could be accrued in the books depending on the nature and
Seriousness, severity.
seriousness of such cases.
And I think most of the OEMs may have a decent amount of team and a process, fair bit of a formal process to deal with such complaints. And they will themselves evaluate which of these are more frivolous than genuine and how many of these are genuine. And accordingly, management, most of the times you've seen most of the large OEMs have a good process of estimating what will be the most likely outcome of such cases. And I think that and the past history should be reviewed to look at how did a particular case conclude finally, what was the initial assessment of management. I think if auditor looks at this data of the past, it gives them a good comfort around whether the management's process is accurate in terms of identifying the amount of provision or a contingent liability disclosure which they're quantifying, and then accordingly an auditor can appoint them.
Yeah. So I think that is broadly what we had in terms of the topics that we wanted to cover. I think we'll just take a look at the Q&A as well.
I think we have 10 minutes, we can.
Yeah. So I think
We have
there's
to read out the question.
there's one question which talks about what is the useful life of a mold. How do you determine the useful life of a mold, and whether or not the life is specified under Schedule 2 of the Companies Act. So I think when it comes to molds, what you need to look at is what is the expected underlying life of the part or component that is going to be produced by a particular mold. Okay. In general, what we've seen is that the life cycle of a particular vehicle is generally in the range of 7 to 10 years. Okay. That's generally when a company comes out with either a significant facelift or comes out with an altogether new model for a particular vehicle. So in general, we've seen that the life of a mold should be somewhere around 7 to 10 years, which coincides with the life cycle of the vehicle that is being manufactured, because it is assumed that once the vehicle changes, that mold will have no use. So there's another question which says, on what basis is revenue recognized over a period of time in this type of industry? So you remember when we looked at the revenue related screen, there were various streams of revenue that we had seen, right? So when it comes to product sale, there generally you would see that goods are recorded at a point in time, because it's a very simple case of manufacturing a car and selling it off to a dealership. Okay. But when it comes to things like extended warranty, and it comes to things like the maintenance contracts that we spoke about, a maintenance contract is basically, where you agree to service a vehicle, let's say for a period of 3 years once it is sold. So in these cases, you would see that while the policy of extended warranty and annual maintenance is being sold by a company to a consumer upfront, the revenue actually pertains to a 3 year or 4 year period, and which is why it needs to be deferred over a period of 4 years. So here you would record revenue over a period of 4 years and not.
Good one.
There is one question which says, in case of PPE, can a company purchase a mold and instead of delivery to them, it is shipped to the vendor outside India? And what is the procedure for audit to be done in such case? So yeah, I think this is similar to one of the examples that we had in our case. I think it was the third example in our slide, which said that the OEM will be responsible for purchase of the mold, but it will be lying at the vendor's premises, because the vendor will be manufacturing the end component from it. So it's a simple case of fixed asset of an OEM lying at a third party, right? And it is possible to have a third party either in India or outside India. As a practice, I think what is required here is to make sure that you are valuing the asset appropriately. And considering this asset may be situated outside India, I mean, the least that you can do as an independent auditor is obtain an independent external confirmation from such vendor to look at things like, the quality of the asset and the situation of the asset. You can obviously ask the vendor to send photographs, recent photographs of the asset, just so that you have some comfort that the asset is actually located there and it is in good condition.
There's one question which says, since the OEMs control the price of all their components, and if such price variation is received by the vendor after the end of the reporting period, how should the provision be done at the reporting date? I mean, I'm reading this end of the reporting period means, let's say 31st March, you've received it after 31st March, but you have received it before the sign off of the audit. Then I would say this is more like an adjusting subsequent event. You will have to factor that in your accrual or revenue recognition, whatever the case may be, depending on your supplier or the OEM. But if it is, assume that it is got finalized after you signed off the audit, then I think you should have only taken care of ongoing negotiations in the subsequent period if there are any evidences which gave you reasons to believe in which direction and how much quantum is being negotiated and was there appropriate accrual of that much piece. I think that's probably is the answer for this question. I'm going to check this one.
When you audit revenue recognition, checking discount and other aspects. Okay, there's one question that says that when you're looking at revenue recognition and you're looking at discount and other aspects, should you check 100% of the revenue, or how should you check it? So see, obviously, when it comes to audit, you are not required to check 100% of the data. But when it comes to things like discount, it would be easier to perform a mathematical rationalization of what should be the expected amount of discount based on the policies that you would have had. So let's say that you have, a monthly policy of discount. So you would have 12 separate policies for each vehicle that is being sold throughout the year. It is easy for you to then take the entire sales register for the year and look at the quantities of vehicles that have been sold, map it to the amount of discount that should have been there for a particular month, multiply it, and then get comfort over the total amount. From a testing perspective, obviously, the audit requires you to test items only on a sample basis, and this is why you will test invoices and things only on a sample basis. But this substantive analytical procedure should give you comfort on the entire.
And also there will be certain levels. I think no one person will be allowed to give any maximum discount. Okay. Normally organizations have limits up to which a discount of up to, let's say 10,000, for example, could be given by level 1. If the discount has to be up to 25,000, then you need a second level approval, and maybe something up to 50,000 will need a third level approval. I think you may have to look at what is the process which management follows to really get these approvals. Is it paper approval or is it an online approval? And what is the mechanism by which management can track how many times was a higher discount given and how many times was a third level approval taken? That could be a good reason to at least ensure the highest discounts were appropriately accrued. Because the risk of going wrong there is much higher, and hence ensure completeness there. If you don't want to do 100% testing, but I may want to do 100% testing of a maximum discounts taken, and to ensure completeness of that, maybe little lesser sample of the second level approvals and probably the least samples for the level 1 approvals taken. So again, I think we'll have to design our procedures depending on where you see the risk is and what is the management process to really identify completeness of discounts.
Yeah, there's one question which is an ROU being tested for impairment. I think this is probably in connection with the vendor related aspect that we spoke about, where we spoke about if you have, let's say, an ROU asset that you're recording for assets that are lying with a vendor, then you need to do a periodic assessment of impairment for such assets as well. So see, from an ROU perspective, I think what you need to look at is, like any asset, you're checking to see what is the future economic benefit that you're going to derive from it. Okay. Now, had you been compensating the vendor on a part piece basis, right? There you would have had a cost that would have come in periodically over a period every time you would have purchased a component from the vendor. In case you capitalize it in your books, then again the cost is coming periodically in the nature of depreciation. If you do end up in a situation where you believe that there is no future economic benefit of that particular asset, then irrespectively, in either case, whether you had capitalized it or whether or not you were compensating the vendor on a part piece basis, there would be a one-time cost that will come to the P&L. Now, this can be either in the form of an accelerated depreciation that you would charge for that particular ROU asset to impair it or bring it down to zero. Or let's say if you were compensating the vendor on a part piece basis, then if you do not have enough demand, then there could have been a situation where you would have needed to compensate the vendor for the entire remaining useful balance of that asset.
Or renegotiate with the OEM a different rate and a different arrangement, which could ensure that in future you will not lose money out of this.
Question which says whether the provision for price variation received from an OEM should be disclosed under provisions or under trade receivables. So I'm assuming this question is for a component supplier who is supplying goods to the OEM, and which is why there will be an additional amount that is being received from the OEM because there has been a revision in case of sales, right? So if that is the case, then you will disclose it under trade receivables, and it will be a manual adjustment that you would have in a sales reconciliation.
I mean, if you're receiving it, it will come under trade receivable, and if you're paying it, it will go under provisions. I'm not sure.
Yeah.
Why is the question under provision?
From OEM, which is why I'm assuming it's a component supplier.
Yeah. Because it's a revenue, then it will go under trade receivables. I think that will be a clear distinction.
Sustainability issues affecting automotive. And what sustainability standards are best fit for the industry? So I think in terms of sustainability issues affecting the automotive industry, I think is this from, if it is from the perspective of environmental related matters, is that what you are talking about?
I think from I don't see auto industry any different from any other industry in terms of sustainability. The additional leg is your CAFE norms or the emission norms, which are applicable to it, which corporates are required to take care, the OEMs are required to ensure. Other than that, I think there's no difference between an auto company, auto component manufacturer, and auto OEM vis-a-vis any other company in any other sector, where you need to ensure that your operations create minimal emissions and you're using the best source of energy and the most efficient processes. I think those are very similar. I think that is what we can understand out of this question. Probably if you can explain your question better, it will help us answer if there is any different, if you not understood the question right. We'll wait for the person to really ask the question again, else we have answered all questions, and I think Ankit or Chandan, if you guys want to take over. I think it's the same person who had asked question around the sustainability. I think the manufacturing process being redundant, I think it's PPE impairment, and I think all that linked cost is there. I'm not sure how you're linking this to sustainability. Sorry, we're not able to understand your question. Right, I think those are all the questions we had. Chandan, are you there? Over to you. Right.
Yeah, I think it looks like Chandan is also. Chandan is here, yeah.
Chandan, we have completed the presentation. We have answered all the questions, most of them.
Yeah, I think so. Someone else from WRC was planned to come, but that's okay. Yeah. So I think so. Percy Irani, I know personally because he was part of WRC committee and he also attended. So it seems like good people from Mumbai and Ahmedabad also joined. So first of all, thanks for accepting, and thanks for coming and taking out time and giving your practical experience to our members in practice and members also in industry. So we could see that there were many members from industry who had joined the session to understand how, as an auditor, they look from a numbers perspective, or how they need to prepare the numbers in their financial statements. That was I could see from the names perspective. And thanks for solving all the doubts and queries. And thanks on behalf of WRC to Vaibhav and Suvir. If you have any still question, I think so. If Vaibhav and Suvir, you are fine, you can share your LinkedIn or any contact details if you are fine, and if they can reach out to you for any questions, etc. If you
Always
can,
available to answer questions. There's no problem. You can share our LinkedIn. You have our LinkedIn profiles. If you want, we can share that again. Share that. That's good.
yeah, thanks for that.
Thank you, Chandan and WRC, for the opportunity. I think it was pleasure taking this session. I hope it was useful.
Yeah, thank you. So officially, we can close the recording and we can close the session.